to some of the parameters of options like delta, and also look at what the advantages and disadvantages are. Okay, so generally speaking, the major disadvantage in any option is the time decay, right? So it's a time decay. Now, in order to overcome the time decay, we are generally putting a spread option, because mostly the time decay to a very large extent can be offset. Volatility can be also offset by doing a spread option. So some of the disadvantages of an option can be removed through a spread option. Alternately, we suggested that probably you can look at a plain deep in the money option, and we said if you are looking at the out of the money option, mostly it will not be that fruitful, but you have to look at the how the out of the money option quantity has to be adjusted in order to get some benefit. So these are some slightly advanced topics, and only those who are practicing it probably can skill themselves on that. But generally speaking, if you do a option with the help of the delta, the result should be more or less okay, except for the fact that probably the amount of volatility has to match with the option volatility. So that is the actual volatility that takes place. If it is equal to the actual volatility which we are buying in the option, then in that case the result of the rollover will be successful. That is what we are saying is that, see, suppose let us say you are doing volatility, because when you are purchasing an option, you are also purchasing a volatility IV. So this is very important. Now let us say 17,200. Say 17,200 for this week or for the month, you are buying an IV which is, let us say, 18%. Let us say it is around 18%. So 18% on a single day, let us say approximately it looks to be like a 200 rupees movement is required per day. Let us say for this 18%. That means what is the volatility? Volatility is the difference between yesterday's price and today's price. Okay, close prices you can take. Now, what 18% represents for a single day? Approximately, I'll tell you how much it is. 1 divided by 18. So this will come closer to the 200 rupees or 225 rupees. Okay, so we have to put 1 divided by 256 into root of that. Okay, into 18. 1.125%. 1.125% on 17,200. I told you 193, approximately 200 rupees. Let us say. So 200 rupees should be the movement in a close to close basis, in order to ensure that the rollover is successful or matches the objective of the cash market. So that is what, if the out of the money option also can behave like that, then absolutely not a problem. So let us say, example, yesterday the close was 17,414 and today it is 17,175. So we have got that more than 200 rupees, right? So in this case, mostly the option which we bought yesterday will be replicating the cash market thing. So when we want to replicate something, then since we are buying in the option, the movement should more or less match the IV. Okay, now let us say if the IV is not matched, then probably we will have some deficiency doing the rollover. So generally speaking, probably if the IV falls, then probably it could have a 20% effect. That is, the rollover that we are doing in the case of a plain option, particularly out of the money option or at the money option, can have something like a 20% difference. 20% difference in the sense that, suppose if you are buying an option which is 100 rupees, okay, then in that case this option should have been bought only at 80 rupees. this option should have been bought only at 80 rupees. So over a period of time, that is if you do consistently, so the volatility sometime can be low, sometime can be more. So on a even scale over a period of time, I think this should match, because in some months or some weeks probably we may have lower volatility, in some months or some weeks the volatility could be more. So we expect that this to get balanced over a period of time, not necessarily every month, but it can get balanced over a period of time. So accordingly, if you want to adjust the quantity a little bit, then it's fine. Otherwise, you will suffer something like a 20% difference. 20% difference means, what I'm trying to say is that, let us say you bought an option for 100 rupees, okay, out of the money option, and effectively probably this could let us say over a period of probable replication adjustment, let us say the market when you did was 17,700, and right now let us say it has come to 17,300, let us say. So 400 rupees should have been the fall in a cash market, which for a 25 delta, for a 25 share, probably we should have lost 10,000 rupees, right? So in this case of the cash market, in case if we do this, there's a chance that probably this 10,000 rupees loss could have probably come to 12,000 rupees loss. That's what I'm saying is 12%. 12%. Okay, so probably because we bought at slightly higher rate and the replication will not be exactly matching, so probably this will be the margin of error as far as the doing out of the money, because if the option volatility does not match, then this result can come. So knowing well that this can happen, we have to, if necessarily, we have to adjust the quality or put up with it, considering that over a period of time probably we will overcome this disadvantage over a period of time. But the involvement of cash market in this particular case is very low. Say for example, for 25 shares, if you want to buy in the cash market, you will buy something like 17,000 into 25. You will be paying something like 4,25,000. 4,25,000, right? But whereas in this case, if it is only 100 rupees, you will be buying, let us say, 55,000 rupees, and into 2 also. Let us say you're buying 2 quantity in order to match this also. It will be 10,000 rupees only. So whereas 10,000, whereas 4,25,000. So you save a considerable amount of money, which over a period of 1 year itself can be 4,25,000. If you're getting 8% interest, it could mean something like a 35,000 or 40,000 rupees, right? 35 or 40,000 rupees. I'm sure that the time decay to a very large extent, I think can be offset of that. So you can put this in a FD, earn some 6-7% interest, and do that only with 10,000 rupees, and whatever interest that you're getting to a very large extent can overcome some of this disadvantage to a very large extent. So you can just do the option replication. So out of the money option replication is also acceptable, provided that at some stage, because you will be surprised to know that when you're doing a replication, the end result may have some difference. The result could have something like 15-20% difference. So that should be kept within the margin, and with a clear understanding that over a period of time it will get evened out. Now I will go back to last week, whatever we discussed at that point of time, and how the option roller would have taken place, and what is the result of that. Now this is slightly approximate, because the number of profits and losses when we take from the end of the day have some differences, because the in NSE screen quote, it comes as a fairly at the 50 rupees range, is slightly illiquid. So because of that, the bid ask and the last quote and the final rate they give is slightly different from actual traded price. So there could be some difference, but overall concept is what we are trying to explain to you. Now 17,715 was the futures, and 17,000 I think 675 was the prevailing price on 11th close was this. Now we 12-13 unfortunately we did not track the price. Then after that we were those holidays, and 18th was the opening. So the 2 days after that, the what we did at that point of time, I told you that we will be a 17,500, 17,900 call option spread. This is what we said, and probably we'll be paying something like 215 rupees or so. approximately 215 rupees or so is what we will be paying in this. So this is what we highlighted by that point of time. So what happened subsequently till date? This is what we are going to explain to you. Now on 18th, it was futures was 17,700. I'm going to write the futures price. Okay, 19th, 20th, 21 and 22. So I'll write the futures price first and then tell you what how the rollover was done. Now on 19.4 we had 18.4 was so 11.4 was this. So this is 11.4. So let me 11.4 was 17,710 futures. On 18.4 17,159. Okay, on 19.4 16,905. Okay, and 24 17,169. On 21.4 17,414. This was yesterday, right? And 22.4 today, it is 17,174. So this is what has happened during this particular time period since we discussed. And since it is 17,710, I told you that we did a 17,500, 17,900 call option spread for 215, right? So 18.4, the price dropped down to 17,159, right? This is what we had written. If you see this, 17,159. Sorry. Just a minute. The screen has gone, so getting back the screen. Okay, so 18th was 17,159. So what was we should have lost money, right? Because we had bought a call option. So what was the loss on 18th between 17,710 and 17,159? So what is the loss? Whatever we bought for 215, now the value was only 60 rupees on 18.4 when the prices dropped. So this had a loss approximately 154. So there was some 61 or so. So 154 rupees was the loss on 18 for this option which we did on 11th. So this is the loss. Since the futures were 17,159, what we did is we rolled it over, because our thing is the delta should be only 28, because the initial thing that we did was a delta of 28. That means it is to replicate 28 shares. So we did 2 contracts of spread option which had a delta of 28 in order to match the cash market share of 28 quantity, right? So now the loss was 154 rupees. Then on this day on 18, because the price was 17,159, on 18th what we did is we rolled over from 16,950 to 17,350. So this was the option trade that was done. And this is also approximately the same 210, 215 rupees approximately was the thing. On the 19th, this also lost value because it dropped from 17,159 to 16,905. So the loss that we suffered was 89 rupees in this transaction. So the second rollover when we did from 16,950 to 17,350 on 19th lost 89 rupees. So we will calculate all these losses together. Then on 19th, since the price dropped to 16,905, so what we did is that we went for a 16,700, 17,100, right? So this particular option which was done on 19th, next day, that is on 20th, the prices rose, right? The prices rose to, if you see, on 19 16,905. On 20th it again back to 17,169. It's 17,169. So whatever that we did on this, the next day it gave a profit which was approximately 74 rupees. So approximately 74. So this is profit. And these were two losses. Then on this day when it closed at 17,169 on that is on 20th, we rolled over the option to 17,000 to 17,300 because it instead of 200 rupees gap, we had to roll it to 17,000 to 17,300 because the number of days was shrinking towards the expiry date, and the delta, in order to preserve the delta of 28, we needed to adjust the strikes. So instead of having a 400 rupees spread option, we need to have a 300 rupees spread with 150 points on this side and 150 points on this other side. So on this day, on 20th, we had the option. It was rolled over to 17,000 to 17,300. And what happened is on 21st, the price is rallied further to 17,414. So because of that, we made a profit which was 61 rupees. It was 61 rupees profit. So now the price has become 17,414. The same thing of 150 rupees maintenance, in order to preserve the delta of 28 delta, we had to do 17,250 to 17,550. So this was done, all approximately the same 210 to 15 rupees. So what happened today? The prices fell, right? So on today, what happened is that we had on this transaction, we had a loss which is approximately 80 rupees. 80 rupees loss. So this was a loss. We had three losses and two profits. 3 losses and 2 profits by doing the rollover. And today, finally, the transaction had to be rolled over. Now we are carrying the rollover into 17,000 to 17,250 in order to maintain that 28 delta for this weekend, which is coming on 28. We needed to keep this. So what was the loss, total loss just come? First time we made 154 rupees first day. Second day loss was 60 rupees. 89. 89 was the loss. These are losses. Profits, the third day and fourth day, we had a profit which is 74. Fourth day profit was 61, right? And today's loss is 80 rupees. 80 rupees. So this was the loss on 18th, this was the loss on 19th, and this was the profit on 20th, this was the profit on 21st, this was the loss on 22nd compared to the previous days, all this. So if you add all these things together, we have 135 rupees profit. Okay, 234 plus 89, 323, right? So the net was 323 minus 135. 188 rupees, right? Is it 188 or sorry, I think some value is 154. Okay. So these are the transaction, but here the result loss was 154.89. There was one calculation that was missing, so I'm just trying to go through that. Sorry, here the profit Okay, so let's say the total loss comes to 188 rupees in this case. So we would have done transactions, two quantities for this, right? So 188 into 100, because two contracts, so 18,800 is the loss in options, right? So cash market, we started something like 17,675 and approximately it is 17,175, let us say. 500 into 28, so approximately 14,400 to 15,000. So in cash market, we would have lost close to 15,000. In option, we have lost 18,800. Now, this gap, I told you, because of the bid ask and other issues which are involved, because we are taking the last price given by NSE, not the last traded price. Because of this, even if a 10 rupees or a 10 rupees adjustment comes in all these cases, because of 5 days transaction, it can just bridge this 3,000 rupees gap. So approximately this is the same. Okay, so let us for the concept's sake, let us say this gap is the difference, and this gap is within the manageable limit of for that 28 quantity, or assuming that this is the cap also, we accept it. But one thing, take it from me, this will be very close to that, because in the actual traded prices this will be very closer to that, within that error of say 1,000 rupees or so. Here we have taken prices which are after the market hours, and sometimes a little bit of illiquid because of the 17,150 range and all. So if you take the exact price at which when it is getting traded a few minutes before, the gap will be the same, approximately the same. So the loss in the cash market is almost equal to the loss in the option trading that we are doing it by doing the replication of the option. So this is what we are trying to highlight. And what is the amount of investment? So in there, you would have invested more than 5 lakhs. You would have invested more than 5 lakhs. Okay, and here you would have invested something like 35,000-40,000 rupees. I told you for two times of this, probably it would have come to 40,000 rupees or so for both the contracts. So whereas 40,000 and whereas 5 lakhs. So that much of amount could have been put it even in the FD, and even if you take that FD interest for the remaining thing, it would have just balanced it. So it's not that we would have lost anything because of this. So the remaining amount, probably whatever that you want to do, you can do it either and keep it in the. You don't need to put that much in the cash market. You could have done it in the option segment itself and got the result for a very low cash outlay, which could have probably replicated for a 5 lakhs. So those who are not having 5 lakhs but can put 40-50,000 rupees can get the same result of an investor who has a 5 lakh. That is what we are trying to say. That is, we are saying that no, you can trade the smaller capital. When we mean, what we are saying is that whatever that you want to put in the cash market, at 10% of that investment which you are putting in the cash market, you can get a very same result. You can get a same result. But what are the catch points? The catch points is that you need to sometimes do the rollover of the option. You need to do a rollover of the option, because if we don't do the rollover of option today, the price of 17,000, the initial transaction that we did 550 and 950, let us see what happens, because we started the market when it was 17,675 and today it's 17,175. So 500 rupees in the case of a cash market, we lost 14,400. If at all we had kept quiet, what is the result that we would have got it? We will see now. See, 17,000. Initially we did the transaction 17,550, 950, right? So right now 550 is going at 22 and 950 has got 18 rupees only. So when we did the transaction was 214 and today it is 18 rupees. The gap, if you had not done anything, if you had not done any rollover, initially you would have around 214, now the value is around 18 rupees. So what is it that we would have lost? We would have lost 214 minus 18, 196 rupees. So into 100, so 19,600. So here also, since the loss when compared to that, the maximum loss is up to a movement which has taken place right up to now. From there, when we did the transaction, we have got around 500 rupees movement, right? So up to 500 rupees, I think we are not having much of a difference. We are not having much of, only thing is, if it is going to go further down, then probably we will be losing something like a straight away this remaining 22 rupees, also 18 rupees that is there, that also we will be losing it. Okay. Now of course, then the cash market transaction also will come to a knot. Okay, will have a further fall. So to that extent, keeping quiet also in this particular case would have been okay. But what happens is, only during the last few days, now you can keep it like this, but last few days when it comes, you should not, because right now, let us say for the same 17,000 to 17,250, let us say you did the transaction on 11th. So till today, assuming you did the rollover, that was the result, 18,800, let us say. You did not do the rollover, loss is 19,600. So cost of transaction, all those things, you may be saying that not much of a difference, fine. So here it is almost replicating the cash market type of transaction, which I told you, we have to accept it, because one is that the quotes which are there may not be exact quotes at the end of the day. Because of that, there could be some differences there. Now, if you are keeping quiet, the last few days, let us say today, now we have done a 17,250, and probably we would have paid something like a 17,300 we have done, I think. So the last day, today we have done 17,250, and we have paid 150 rupees or so. So suppose if the market sinks, then 150 rupees means from here it is of a great value, because 150 into straight away, you lose under 2 contracts, you lose 15,000 rupees. So from here in cash market, you will not lose 15,000 rupees within a week, because then it has to go down nearly by 500-600 points from here to lose that amount. So the last few days when it comes, it is better to do the switch it to some other rollover expiry. So right now it is better now to switch it to the next month, okay, because now with only 3-4 days left, I think on Monday, better not to keep it till the last day. You can just do a switch over to the next month option, and thereby preserve yourself. So here we have seen that if the positions have generally been static, it would not have had a problem. Okay. Now if it had sunk a little farther also, even without rollover, probably things would not have come to very I would say considerable loss of difference compared to the cash market. So if it had gone up, then you would have had a good amount of money made compared to even the cash market. Okay. So all these things shows that probably if you don't have you don't need to have huge capital in order to get a result which is very similar to the cash market. So that is what the entire purpose of the webinar is, to say that the amount of capital required is not much. Second thing is, you can look at the transactions. Once you do a particular transaction, wait for some period probably also. You don't need to do the rollover every time. Every 100 rupees, 200 rupees, you don't need to do the rollover. You can probably wait for some time to see whether, if the market flares up to a very considerable extent, you're going to get a good profit. If you are going to have a fall which is approximately, which I told you is around this 500 rupees it has come, I think up to this or even a little lower, we are not going, because suppose if this again 18 rupees we are going to lose in this transaction, then in that case you will lose another 1,800 rupees. But whereas in the cash market, another 200 points fall, I think probably you will start getting almost a break even. So that means at a rate which is 600-700 points, because when you did the transaction, probably we must have seen the option price, at the money option price, close to 300 rupees or so. So when it comes to close 300 rupees or so, unless it starts really moving by more than 600 points, I think the amount of losses that we may make in this case will not be significantly different. But only thing is, if it stays very closer to the option price, and the last few minutes, last few days, the decay can be a little, the decay can be much rapid. So at that point of time, please take care and ensure that the rollover is done to the next one. So that is the only precaution that we have to take. So very closer to 1 week before the expiry, we need to assess whether we should keep the contract or do that. Now, the second thing is the same thing as far as the out of the money option also is concerned. Now, out of the money option is also a decent proposition comparatively, provided you get a same volatility, actual volatility. If it matches the implied volatility which you are buying, then absolutely you can buy those contracts also and do the rollover at some intervals. You don't need to do at every 100 rupees or so. Maybe you can do at some intervals. That particular contract also you can do that some intervals. So that also you can evaluate of the out of the money option also. Now let us say the out of the money option right now for the we told you that 17,250 or 17,300 option. Now for this particular week is going at 85 rupees or so, 85 rupees or so, and 17,250 which is a delta of around 34 or so is going at 106 rupees. So the maximum loss that probably in this particular case that we have to do two contracts. So two contracts means maximum loss is around it could be around 300 rupees, it could be 106 into 50 to 10,000 rupees. So if the market is going to fall by around 250 to 300 rupees, then in that case no buying out of the money call would not have made any difference. But if it just remains static, then in the case the cash market you would not have lost anything. But whereas in the case of a option, you would have lost. So the volatility matters. So if the volatility is absolutely, because you buy and you don't do anything, and if it just comes flat at the same price, then in that case you will lose some. That is the reason why you need a constant rollover as far as out of the money option is concerned. So do the rollover at some intervals rather than at every 100 points or 200 point swing, because that could probably increase your cost. So this is what we are trying to say that. And probably what we will do is that we will look at one out of the money call option right now, which we will keep it for probably next month, just illustration. And at some stage there we will evaluate how it could have how it would have worked out. So probably we will look at one out of the money call option. Probably for this week is we will leave it. We will take it for the next week, and that is this is today is Friday, right? Thursday, the second Thursday we will have it, and we will look at how this option had fared during this particular period. Okay, so let's look at now the for the next settlement, 5th May. So 5th May, we will take, let us say now prices closer to 244 rupees or so, and so we will look at the delta now first. So the futures in this particular case is 17,000 for that particular week is around 17,000. Approximately it is 17,200 or so. Going by the option prices, we are getting something like 17,200. So we'll look at the option price calculator, and we'll this is in white background, unable to help you. So underlying price is, let us say, 17,200, and we will take a 17,400 call option. Days to expiration, this is 3rd May, right? So today is, we are on 22nd, so we'll put it as 11 days. 11 days. So interest rate is 0 because we are taking the option price. Dividend yield will put 0, and we will take the volatility. Let's say in order to match the price, we'll take it 16 and see what happens. So 108, and let's say the price. So 17,400 is 121. So we may have to take okay. So the delta at 200 points away from the present price is 35.35. So let's take this way. We'll write 17,200 futures, 17,400 for 3rd May. Okay, 17,400 for 3rd May with a delta of 35. Price is 120, 119. So we'll keep it thus. That is delta. Sorry. Yeah. So now approximately 17,200 futures price. So for 3rd May, we are taking a 17,400 call option, and the delta is 34, I think. That is 35. So we are taking one option, which means it is because for 50 then it becomes like 18 shares. Now it is equivalent to 18 shares at 17,175. So let us say we are now doing one contract of 17,400 call option, and the price is 120. So we are paying 6,000 rupees. Okay, and equivalent to this is buying 18 shares of 17,175. 17,175 into 18. It is 3,09,000. So let's see what the result is and how the option replication works in this particular case, whether volatility matches that or not. We will see, because actually if the actual volatility is going to be now the actual the implied volatility that is being done in this case is 17%. So we need to get a movement approximately an every day or an average per day. We should get something like a 200 rupees movement. 200 rupees movement. So if you get an average 200 rupees movement per day, I think we will it will look to be it will be good, because otherwise, see what happens is why the rollover is very important. Now let us say in the same case we now going to this price. See, 11.4 was 17,710, 18.4 17,159. On 22nd, again you are coming back to the same place. See how many days? 1, 2, 3 days. It has come to the same place. 17,154, 159, 169, 174. Okay, so these prices have been traded. Now it has come back to. So that means if you keep quiet, it will imply as if these 4 days the volatility is 0, right? Because it is the same price. But in between, if you see how much movement has taken place, here is more than 200 rupees. Here is again more than 200 rupees. Here is again more than 200 rupees. Today is also more than. So in these cases, the volatility of 18% would have worked. Here also on 18.4 probably on a single day or something. So here the volatility probably would have worked out. That's what I'm saying. That probably over a period of time this will the volatility will work out. So you just buy a call option of that money, and then if you want to be a passive investor also, you can trade that way. So now let us say market comes to some reasonable value, then in that case you start buying that call option and keep trading it in that format and see what the result is. Now what is that particular level which probably you would like to do? Now let's say we go to the Nifty price, go to the daily chart, big chart, look at the weekly chart. So the weekly chart, okay, see, the weekly looks to be there was about 17,800. So I think the prices seems to be okay. Now we'll put a Fibonacci thing retracement. So it came to 16,000. So 16,600 is a possibility. Okay, in case if the market starts to drag down further, 16,600 is okay. I think we can look at around 16,600 how it behaves, and if it starts working, going above 16,600, because I think 16,600 can also, they're saying it's a fairly fair value also as for the market is concerned. So I think probably we can look at 16,600 range. and from there we'll look towards buying the option. From there we'll look towards buying the option. And second thing is that we have also talked about 18% months volatility, right? So 18% in a way for the full month, it will translate into 5.19%, which approximates around 850 to 1000 points, is what the market is expecting. The high to low also could be around 1000 points swing, 1000 points from high to low. So in this particular week, if you see 1000 points, it's more than 1000 points. In this 18,114, slightly more than that. So it has come down to 16,824. So probably during the rest of this week, if it spends above 16,824, then 1000 points swing would have been over. So then probably we are looking at the 1000 points swing. High to low swing is going to be something like a 1000 points swing we can take. So if that be the case, then next week or next month or next week, if it comes down to 16,600, it can have a fairly decent value, which can go up to 17,600. If it starts moving from 16,600, it can look towards up to 17,600 also, 17,600 levels also. So somewhere around 16,600, which is a decent Fibonacci ratio, we can look towards buying. So when you look towards buying anything, or when you get a feeling that you are going to buy and work on this, then in that case you can look towards out of the money call option also, and do the rollover according to the delta formula that is there in the option price calculator. So now if you have any questions on this, you can ask, and otherwise I will go to the view that we have right now on Nifty and Bank Nifty. So any questions probably you can ask now. And Nifty, Bank Nifty will... So you see this particular one, it came down to 16,893, and it just tried to move above 17,188, and now again it has started to fall below 17,188. So this particular level is going to be a very important resistance. That's what we said, because this is also the low of one particular period, and this was also an important high, 17,442, and so it has come up to 414. So the first expectation is that 17,414 can hold, and if that be the case, then we can see a dip which can come right up to this level, which can come right back up to the 16,900 levels. There we have to see whether it is going to form a double bottom, or depending on the international market scenario, whether it is going to go down further. That remains to be seen in during that point. So for Monday, we have to look at the one thing that we can say is that we have to I will put it this way. Now on Monday, if the rally is going to be more than 130 to 140 points from any bottom, then only we can say a bottom is formed. Today, what happened? You see, in today's case, if it fell down to 17,000, it came later on. So today, the first 2-3 points which I would like to mention. So this is the gap down. So today was a gap down. We have already mentioned that most of the gap downs are probably needs. Sorry, here it is. So the gap downs, if it happens even on a closed basis, then then it's considered to be bearish. So yesterday it was bullish, so we should have done this with this as a stop loss, right? So today it also came down to the same. The close here was 17,149. So now it came down to 17,149. No, see, this was a gap again. So it was a gap lower. So which means that at any point of time, probably it can fall. So if that be the case, what we should do is that see it just started to go up. Then this is an hourly chart, right? So this is an hourly chart. This is hourly chart. So here on any hour break, we can look towards going short. We can look towards going short. Now in this particular case, when it opened like this in this day, okay, then in that case what we can do is that we can keep last 2-3 hours low as a stop loss, or this close itself as a stop loss, and do the trade. So here today we could have gone short below 17,275. Below 17,275 we could have gone short, keeping 17,315 as a stop loss. So now that point remains. Now I would say that at any point of time, if there is going to be more than 130-140 points from the bottom only, the rally will resume. So why do I say that? Now let me say, go to the Fibonacci for that. Now let me say, so today I have drawn this, and so when the low was made today, we said very clear 17,331 has to be taken off. It did not happen. So now let's go to this. So now it is 17,292. So this can keep coming a little lower. This can keep coming a bit lower. So right now we are looking at 17,292. Only about 17,292 or 17,300. We can look towards going on the long side. So where are the other places that it can come? So we'll look at the Fibonacci retracements. For this entire move. $17,116. Okay. Then 17,046. So this is the place. So what we expect there from this is 17,000. So first support 17,116, second support 17,045, 17,045. If that happens, then in that case what we should look towards is that we should if it comes to 116, then plus 140 approximately, I told you, can be the this one. So 17,256 will become the resistance. Okay. If it comes to 17,045 plus 140, so it has to move above all these things for it to really get back into the buy mode. So the only thing that you can do is if you want to buy it on dips, then you should buy at 17,045. Okay. And then in that case you should look towards putting a stop loss, which is 16,945. So if you buy at 17,045, then in that case the stop loss will come at 16,946. So to overcome that, so the problem in order to overcome that is just wait for a fall. Let us say it comes to 17,116 or approximately that. So it has fallen from 17,415, right, to 17,116. So for the 300 rupees, what is the 0.235%? Is around 70 paise, right? So first it has to move above 17,186. Okay. So what you do is that in that particular case, you buy above 17,186. Okay, keeping this stop loss of 17,116. Then if it starts moving up to 17,256, you will see definitely some resistance coming. Definitely some resistance will come. So whatever you did here, you try to take profit here. Okay. Then after that, if it starts again falling, what you should do is that now, since I told you it's around 70 points from there, then the next thing will come 17,000. So from 17,256, if it starts falling below 17,186, you do one thing, then you can go for a sell here, keep this as a stop loss, and chances it can move down to 17,040. So this is what our trading view will look like. That is, first let it come down to 17,116. Okay, if there is no big fall, if it is a gradual fall, 17,116 will offer the first support. From there it can have a bounce. If it starts going above 17,186, then in that case you can buy with a stop loss below 17,116. But 17,255 around that level will offer resistance, so you have to come out of the stock at that point of time. Then again, when it starts dropping below 17,186 or so, you can go for a short, keeping that particular high as a stop loss. I'll see what happens then. So this is what probably, this is the way you can approach this. Okay. So now any questions, please ask. Thank you. So I replied the Nifty Monday trend. Any particular question? Because no, sir, somebody has replied. So I just want to know what exactly is the thing. So the Monday Nifty trend, as I told you, we right now, since it's a bearish day today, so we should expect some sort of a bearishness in on Monday. Okay, so it all depends on international development, because day before yesterday we had a very good yesterday rather we had a very good close, but today if you see, there was a fall, but we should be in a position to anticipate. Now yesterday we are anticipating 17,420, 440 can be a resistance. That is also based on the Fibonacci. So that point of time we had concern, but we cannot go for a short immediately. So what probably we would have done today, when it came down below 17,270 or so, we could have gone short, keeping yesterday's high of 17,414 as a stop loss, and then it came down to this particular level of today. So now we have to see whether it is able to get 0.235% retracement from 17,415 to whatever levels it has fallen down. That will be a stop loss. So let us say if it does not move on further, then from 17,415 to 145, it's approximately 270 points. On 270 points, 0.235, whatever is 60 or 70 points, we need to get out at 17,210, 215 levels, and then see again how it works. Okay, so this is how we have to keep shifting our ideas based on this. So what would have happened today is that there was a fall straight away. Okay, but it was a gap down fall. So we know that it is likely to be a selling day. So when it is selling day, what we should do is that we should look at and also it cut yesterday's low, right? It cut yesterday's low also, I think, subsequently, or around that point it had cut. I think yesterday's low was cut, and so what we should do is that we should look towards an opportunity to sell. So when it started to climb to some level, which based on the Fibonacci retracement, we should go for a sell, keeping yesterday's close itself as a stop loss. Okay. Thanks for your participation. Hope to see you with some other new subject on next week. Thank you very much. Bye.